selling a cover call is actually, in theory, a fairly simple strategy. What you're doing is you're selling a call option against a stock position that you own in order to generate income on that existing stock position. Now, just to break that down a little, when you sell a call option, what you're obligating yourself to do is to sell the stock at a specific price. Now, a call option has a strike price, it has an expiration date. When you sell a call option, you're obligating yourself to sell your stock at that strike price by the expiration date of that contract. Now, because when you sell just a call itself, you're obligating yourself to sell it. The only way that investors are allowed to sell a cover call is if you own the shares that you eventually have to deliver on that to make good on the delivery. Otherwise, you have to come up with the shares at expiration in order to satisfy that obligation. So we call it a cover call because you already own the shares in the underlying stock and you're selling a call option against that stock position. Now, the call option that you sell will generate income. And we want to talk a little bit about this income that you're receiving. How much is it? How much income are you going to receive? And what trade-offs do you make in exchange for this income? Now, there is one limitation here to selling a cover call because the fact that each call option that you sell on a stock that you own, each call option represents 100 shares of an underlying stock or ETF. So in order to sell a call option, you must own at least 100 shares of an underlying stock before you can sell a call option. So for those really high price stocks, perhaps that you only own 50 shares or 25 shares, this is not a valid strategy for that. However, for any stocks that you own at least 100 shares of, this is a strategy that you can deploy in your portfolio and potentially generate income. Now, when you sell this call option, what happens is you actually collect premium. And I think for those of you that have never traded a call option before or have never sold a cover call, you can think of selling a cover call as similar to placing a limit order to sell your stock at a higher price. So just to illustrate, H&M right now is currently trading at about 214 and a half crowns. I put this slide deck together a few days ago, so the stock price is a little different. But think about placing a limit order at a higher price, let's say 230 crowns. If let's say you placed a limit order at 230 crowns, when the stock rallies higher to that $230 level, you are obligated to sell your stock at that price. When you place a limit order, that's what you're doing, is you're obligating yourself to selling the stock at a specific price. The difference between a limit order and a call contract is that a limit order will execute as soon as the stock rises to that price, versus a call option will generally execute or be executed upon at the expiration date. So there are some differences, but the obligation is the same. But the difference here is that when you place a limit order doesn't pay you anything. The only thing you get is the capital appreciation between 230 crowns and the 214 and a half crowns that the stock is currently trading at. So the difference between the two, that's the potential profit that you can have on the trade. Versus when you sell a call option, just by selling the call option itself, so think about placing a limit order. Just by doing that, you're going to be collecting premium. That is the income stream that we're talking about. So even if the stock never reaches the 230 crown price, you still get to keep the income that you receive on selling that call option. So just like a limit order, once you sell a call option, there are two possible outcomes. Let's say you sell a 230 strike call option. The stock can either be above $230 at 230 crowns at expiration, or below 230 crowns at expiration. Now, if the stock goes above 230 crowns at expiration, what happens is you effectively sell your stock at the target price or the target strike price, which is 230 crowns. So just like a limit order, if it exceeds that price, you've sold your stock at that specific price. So in the case of a cover call, same outcome. If In the other case, if the stock is below 230 crowns, so it could be 229, 214, 200, any price below $230, 230 crowns, what happens is you keep the income from the cover call. So a limit order that goes unfilled, you don't get to, there's no income for you. But a cover call that goes unfilled, you get to keep that income. So when we refer to an income stream, what that means is that by the time that the call option expires, if the stock is below your strike price, you can choose to sell another a cover call. You can sell another 230 strike or 240 strike or 220 strike, whatever price you want to place your order to sell the stock at again and collect more income. That's what we mean when we refer to an income stream. And when we go through some examples here, we're going to show you that the average yield many times on a cover call is typically higher than the dividend yield that you earn on the stock itself. So let's say I own 100 shares of H&M. And let's say I bought this stock at 200 crowns. So I bought the stock at 200 crowns earlier this year. And my goal is I want to sell these 100 shares at 235 crowns. That's my target price. So I think this stock is going to rally to 235 crowns, and I would like it for that when the stock reaches that price, I'm able to sell my stocks and take my profits. So like I said before, we have two choices. As an equity investor, for all of you that answered no, you would probably today place a limit order to sell your stock. And you would place your limit order at the price that you have, the target price, 235 crowns. You place a limit sell order at 235 crowns. What I want to show you is an alternative to that, which is selling a July 235 crown covered call. In this particular case, selling this cover call will generate 3 crowns in income. So 235 crown stock, I'm generating 3 crowns. And that's not going to sound like a whole lot. But as we go through some examples and we start looking at yields, we'll start to see just how much that adds up to. So what we're going to do is we're going to compare a limit order to selling a covered call. So in the limit order side, my risk remains the same. If I bought the stock at 200 crowns, my risk is going to be 200 crowns. That's if the stock goes bankrupt. If H&M goes bankrupt and they have to close all their stores, the stock goes to zero, I risk 200 crowns. If the stock reaches my target price of 235, my potential reward here is 35 crowns per share, because 235 minus the 200 that I paid is a total of 35 crowns per share. And I effectively have exposure to H&M until H&M rises to the $235 crown target price that I have. And until that happens, I have exposure to the stock, and I could potentially collect the dividends if this is a dividend paying stock. Now, H&M is not a dividend paying stock, but if it was, I would collect dividends until the stock reached that price. So on the flip side, what I want to do is I want to start taking a look at what does a covered call investor look like in the same scenario. First of all, my risk is reduced because I collect 3 crowns on the cover call, which means that my total risk is immediately reduced down to 197 crowns per share versus 200 crowns. My potential reward is increased to 38 crowns from 35 crowns because I'm now potentially targeting 235 crowns, but my cost basis has effectively been reduced by 3 crowns on the stock position. And now I get to generate income from my cover call. I get to collect dividends if it's a dividend paying stock, and I can do that until the stock rises to 235 crowns. So on one side, I can only collect the dividend yields. On the other side, I get to collect cover calls and dividend yields until the stock rises to 235 crowns. So the net outcome here are a few things. One, I have a lower break-even price on the stock, 197 crowns versus 200 crowns. I have at least 3 crowns in potential return because I'm collecting 3 crowns from selling that cover call. And that comes out to be 1.5% additional potential gains on the strategy. Now, like I said, many times investors will say 3 crowns doesn't sound like a whole lot, but think about this in yield terms. This is 1.5% between now and July. This is a stock that currently pays 0 dividends. Even a dividend paying stock many times will pay 1.5%, 2%. but that's over a full year. This is 1.5% over just a 2 month period. So if you think about that over the long run, if you're able to deploy this strategy on many of the stocks that you own, it adds up to be quite a bit of yield. And many times the yield percentages are significantly higher than what you're collecting on the dividend itself. Does that make sense, everyone? Please type 3 into the chat window if this makes sense to you. And we'll talk a little bit about the mechanics of these types of trades here, but I'm glad to see a lot of 3s, meaning investors are understanding this. So let's look at H&M and let's look at some real calls that you could potentially sell against H&M. So right now we have a scenario. This is from last week where H&M was currently trading at about 214.5 crowns, and so just like a limit order, right? You can place your limit order at any price higher than the current price. You can, you could have a target price of, let's say, you can have a target price of, let's say, 225, 230, 235, 240, 250. You can choose how far you think the stock is going to go. Now, just like a limit order, you can choose your strike prices. So what I want to show you is how much premium or how much income you're going to collect on this strategy. And I want to talk through what do you use to select the optimal cover call. So right now it's at 214 crowns. 214 crowns. I have 3 opportunities. I have the 225, which is roughly right here, the 230s, which are up here, and the 235s, which are all the way up here on this particular chart, right? So 225, this is 25, this is 30, and let's say this is 35. So depending on where I think the stock can go, I can choose 225, 230, or 235. Now, if I sold the 225 strike price, meaning I would let go of the stock at 225, this would collect 6 crowns in income. If I selected the 230 strike, this collects roughly 4 crowns in income. If I selected the 235, I collect 3 crowns in income. Based on our back test, which strike price makes the most sense in the long run? And the answer to that question is this one, 235 crowns, the one that actually collects the least amount of income. And I want to talk through why. Because a lot of investors are taught, for those of you that have traded cover calls or learning cover calls, it's taught as an income generating strategy. So I tend to find that a lot of investors will prioritize collecting as much income as possible on that strategy. But in my opinion, based on our back testing this strategy over thousands and thousands of trades, from our perspective, the answer is very clear that you should sell a fairly out of the money call option. So a call option that's pretty far away from the current price of the stock, and actually collect smaller amounts of income. And the reason for this is because, and especially for those of you that have traded options before or sold cover calls before, it really hurts when you sell a cover call and the stock shoots up. Let's say it shoots up to $235 or $240, and you sell a cover call. And what happens is, because you sold, let's say, the 225, what happens is you miss out on all of these potential gains. Because if the stock shoots up to 240, you sold your stock at 225. You've missed out on 15 crowns worth of gains to the upside. This could be some kind of news event. This could be earnings. This could be anything that causes the stock to surprisingly rally significantly. And what you see here is the fact that the difference between the 225 and the 235 strike price is only 3 crowns. So here I collect 3 crowns and here I collect 6 crowns. So what you're doing is you're giving up 10 crowns of upside in exchange for just 3 crowns of income. And what we see here is that over the long period of time, that's going to be a scenario that's always going to work against you. Yes, you collect 3 crowns more by selling the 225 cover call. That's going to generate more income for you. But every single time the stock jumps, you give up so much more in exchange for that. And that is why our back-tested strategy clearly shows that when you're selling a cover call, you actually want to sell a fairly far out of the money call option that will generate on paper less income. But remember, the income portion of the trade is actually a relatively small amount. What the most of the income that you're receiving, or most of the gains that you're receiving, is from the stock that is going to rally. Because 100 shares of a stock going from 224 to 235, that's a few hundred crowns that you're talking about. Sorry, that's a few hundred crowns that we're talking about in terms of I'm sorry, a few thousand crowns in terms of potential profit on the underlying stock itself, versus if you had you're talking about just a few crowns in terms of income. So this is really something that you have to pay attention to when you're selling a cover call. Now, the question is, how do you actually determine what constitutes as far out of the money or close to the current price? And that's where we turn to delta. For those of you that are new to options trading, each strike price has a Greek or a metric tied to it called delta. And what delta estimates for us is the probability that the stock will be above that strike price at expiration. So obviously the strike prices that are close to the current price have a higher probability that the stock will be above 225 than for the option to be for the stock to be above 235. So the higher the strike price, the lower the delta. Now, the reason that we use delta to choose our strike prices is because if we use a probability-based approach and we always select, let's say, a 20 delta call, then that means 80% of the cover calls that we sell we will get to keep the income. And only 20% of the time will the stock rally significantly, and we get to take profit when that stock rallies significantly. So what you really want to do is prioritize being able to take profits on your stocks when they rally significantly, and at the same time generate a smaller income stream but a more consistent income stream where you know approximately 80% of the time you sell this cover call, you're going to keep the income, and the 20% of the time that the stock makes a big move, you're going to be able to capture most of that big move and not lose out. Because if you sold the 225, then you know that only 65% of the calls that you sell will generate this higher income, but 35% of the time you're likely going to be losing out on significant upside, because if the stock was to rally from this 214 to 235, whatever rallies above 225, you're going to miss out on, and you're missing out on that in exchange for just roughly 3 more crowns of income. And you'll see that even the 20 delta, which is far away and it requires the stock to really make a big move, you're still generating here an annualized return of 9%. You're earning 1.4% in 60 days. This is a stock that pays 0 dividend yields. If this is the equivalent of effectively adding another 9% on top of that to that dividend yield, because you're collecting approximately 1.5% in 2 months. You annualize that over the year, you're looking at approximately 9% in terms of yield. So a lot of times, a lot of investors will say 3 crowns sounds like very little, but you really should think about it in terms of the dividend. And think about it. Am I beating the dividend? How much yield am I collecting with respect to the dividend? That is a much better measure of how much income are you actually receiving. Now let's talk a little bit about, once you're in a trade, how do you get out of it? How do you manage a cover call? So once you sell a cover call, there's basically 3 scenarios. The stock moves higher, the stock moves sideways, and the stock moves lower. So we'll talk through each scenario and how to deal with it. So let's first talk through where the stock shoots higher and exceeds the strike price that you've sold. So let's say the stock goes from 200 to 240 immediately after you sell the cover call. It's now above the strike price that you've sold. This is really where I see a lot of investors tend to panic, because they see this large gain on the stock, but then they also see this loss on the short call, and they want to know what to do. And my best advice to you when the stock rises above the strike price on a cover call is to not panic, and there's not much that you really need to do. You really just have to hold on to the position. And you have 2 choices. You either will say, okay, I was comfortable at selling my stock at 235 crowns. I'm going to let it go. I know I can't make the maximum profit on every single trade, so I'm happy selling at 235. You basically hold that to expiration and you basically take profit on your stock. Now, sometimes the stock makes a big move, maybe on some news that you didn't have before, and you now have new information, and you're thinking to yourself, well, before I thought the stock could reach about 235, but now I think the stock maybe could reach 270 or 280, right? Maybe because of there's new information now, you're thinking that this stock can go much higher. So if that's the case, what you have to do is you have to buy back your 235 call option, because if you don't buy it back, you're going to sell your stock at 235. So you buy it back to remove the obligation. And what you do is you effectively sell a new cover call at a new target price that you have on the underlying stock. But if you're going to do this, if you're going to roll your cover call, which is buying back your existing call and selling a new one, you have to do it only in the last 2 weeks from the expiration date. You do not want to do it early. You want to wait till roughly 2 weeks from expiration, then you buy back your call option that you've sold and sell a new one. Now, in the second scenario, where the stock trades sideways, this is really your best case scenario. There's not much that you need to do in this particular case. You simply hold the position either until expiration, or you can roll it at 21 days from expiration. From my perspective, this really comes down to whether or not you want to take on the risk of potentially losing your stock. Some investors really don't, have the intention of holding on to that stock. They don't want to lose that stock. For those of you that want to hold on to the stock, you want to roll it at 21 days. If you're okay with the risk of potentially losing it, then just simply hold your position to expiration, let it expire, then sell a new call. And only if the stock declines after you sell a cover call is it really an opportunity to do something early. And this is really where, depending on how far the stock has declined, will determine whether or not you react to doing something early. So let's say I sold the 235 crown call option. Let's say I sold it for, let's say, I'm going to use 10 crowns as an even number, just to make for an example here, right? We knew that this was only collecting about 3 crowns, but I'm going to use 10 crowns for a round number just to illustrate an example. And let's say the stock drops significantly. What you want to do is you want to monitor the call option here, because if this call option drops in value to, let's say, 2 crowns, so 20% of the value that you originally sold it for. So you sold it for 10, and now you can potentially buy it back for 20% of the original premium. That is usually a good time to simply buy back the call option and potentially sell another one. Now, because the stock is now down, let's say, to 200 crowns, right? You might now only sell a 225 or 220 strike price, but you want to revisit what is the appropriate strike price at that time. But basically, what you're doing is you're basically profiting the 8 crowns that you sold it for versus the price that you buy it back for. You're collecting that 8 crowns faster than you originally expected, because you're expecting that you would have to hold this trade pretty much to expiration to collect those 8 crowns. Now, if the stock drops quickly, you can collect the 8 crowns very quickly, and you can sell another call. So that's really, the 3 different scenarios that you can find yourself in after you've sold the cover call, and how to go about dealing with each one of those scenarios.